Long bond TLT rally is a warning sign for you to sell stocks, while lag effect will hit on this date. Like many people, was quite concerned entering 2023 that a recession was all but inevitable, but it never showed up as the year nears its end and a new one is ready to begin, 2024. Did we indeed dodge a bullet? Or has the recession only been delayed, now ready to make a landfall in 2024? Perhaps with even stronger destructive force. If you have watched my GTA 6 video about TTWO stock, I have to add one more point as to why I think it's a buy. Is that since the start of 2013, the release year of GTA 5, TTWO stock has outperformed S&P 500 by 1,000%. The performance even beat out Apple stock. Of course, past performance doesn't reflect future results. We are heading in different seawater with high interest rate and inflation landscape. But no matter what, GTA 6 is going to sell like hotcakes. Did you hear me? Like hotcakes? Just like GTA 5 or even better, because people have waited for more than a double the time they have waited for GTA 5 from GTA 4. Just think about it like this. If you bought an iPhone 5S in 2013, it probably cost you $1,000. If you had bought Apple stock with that $1,000, you would 10x your money. Today, with the $10,000, you can afford to buy several iPhone 15 Pro Max. The same will happen with TTWO stock. Granted, you are probably not spending $1,000 on GTA 6 online right off the bat. Nonetheless, investing in TTWO at the right price today makes a lot of sense, right? Now that's over with. I have proven myself not a doom and gloomer. Let's talk about macro. I just want to start off by saying that I don't believe the hype from the mainstream financial media. There will be no soft economic landing, and we are not in a bull market now, and we are not going to be in a bull market next year. Let's just go over some facts, okay?
How you like that?
Good for stock. You think the S&P 500 could rise as much as 17% next year? How?
We do. Our price target on the S&P is 5,200 to 5,400 for 2024. Right now, consensus earnings growth is up about 11% from this year to next year. But if you look at Q3 earnings announcements, companies came out and while revenues were mixed, margins stayed strong. And we think that's because they had 2 years to adjust for higher interest rates. And we think that that'll translate into a good market next year, and we could see additional earnings surprises to the upside.
The bull market ended in late 2021, and the S&P 500 is still down 4%. That's in nominal terms. It's 4% since it's peaked in November of 2021. And when you inflation adjust those numbers, it's much worse. And that, of course, includes the Magnificent Seven that are solely responsible for boosting the index. So you have basically 7 AI stocks. They are up 80% in 2023. The other 493 stocks are up 4% this year. Just 4 lousy percent, and that's after being down 20% in 2022. But you listen to like CNBC and you think, oh my God, there's this massive bull market that I'm missing out on. It's just not true. They're also trying to convince you that 2024 is going to be very soft, cushy landing. They're wrong. They are so wrong on both counts. Let's go through some more important numbers. The Russell 2000 is down 27%. That's 2000. That's not the Dow 30, the NASDAQ 100. It's 2,000 stocks in the Russell 2000. 27% since November of 2021. And the 60-40 portfolio, which includes bonds, it's even worse. If you look at the benchmark Treasury long duration, you know middle of the curve and longer, that it's down 40% since 2022. So the worst is ahead because the silent issues have not been resolved. And what are the silent issues? The silent problem all stems from this. We had a sub 1% interest rate, Fed funds rate, for 11 of the 14 years from 2008 to 2022. And what did that do? That led to a massive amount of debt to be accumulated, an unserviceable amount of debt, especially under a normal interest rate regime. And it also led to an unsustainable levels of asset bubbles, and those things, they haven't gotten better, they've gotten worse. So a crash landing is still coming. The timing for that is crucial. I expected the recession to start, and it hasn't officially begun yet. And that's important because when the recession officially begins, the average decline in the S&P 500 is 32%, going back to data since the end of the Great Depression. 32% from the start of the official recession. That is something I think is going to happen in 2024. In general, the market hasn't gotten anywhere, and the real economy is teetering on the collapse. Just hasn't happened yet, and I'm going to go into the reasons why I think it is going to happen. What are the reasons for thinking that Magnificent Seven miracle is not going to keep the party going next year? It's history. Big sign history. Not that I am some AI expert, but if you look at the past history, whenever you saw a consolidation into just a few names of stocks, think of the Nifty 50 stocks that got crushed in the 1970s market crash. And this is evident also in other countries. Whenever you see a very narrow stock market led by just a handful of names, not the Nifty 50, the Nifty 7, it never ends well, because you can't have a healthy market when you only have a few stocks are participating in that bull market. If you look at the equal weight S&P 500, it is down 10%. It's still down 10%, including the AI stuff, in the last 2 years. So I'm not saying that we need a collapse of the AI narrative for the market to correct. Listen, in a recession, the S&P 500 drops 32%. That includes everything, Nifty 50s, AI, everything. So I am not going to sit there and tell you that just because AI is the technology of the future, and I believe it is, I can't wait to invest in it, that's going to save the stock market or the economy, because the earnings growth rate that they are predicting of 11% is never going to happen when nominal GDP is crashing from where it once was to where it is going to be in 24. So you're going to have an earnings miss in the S&P 500. And of course, as always, sectors are important. But if you play this carefully and you get your timing right, there's a tremendous amount of money to be made after this consummation of this reconciliation of the asset bubble occurs. That includes real estate as well. There's a tremendous opportunity to get long by buying profitable, high quality growing companies at the right price. What I think is going to be a protracted period of stagflation, such as this country has never seen before. Why has the recession been delayed? I have two reasons why the recession has been delayed, but not canceled. So number one reason is massive fiscal stimulus from our president, Joe Biden. The other reason, number two, is the terming out of debt. The terming out of debt is when you lock in 30-year fixed rates on your mortgage and you don't have to have adjustable rate mortgage because you sell your house or your corporations, which have locked in long duration debt, out at very low interest rates. That is changing now. What's happening now that lets me think that as these interest rates have been increased from 0 to 5.25% to 5.5% on the Fed funds rate, as you go through the time, you will see people refinancing into higher mortgages and issuing debt at higher rates, which is going to lead to the recession. This is the situation now we're facing, where we have these higher rates, and these higher rates are putting a tremendous amount of pressure on the governments. And if you don't have the central bank monetizing that debt, this is like the mantra of the mainstream financial media. Well, as they say, government's debt doesn't matter because they could just print it and monetize it all the way. Well, that's true. It is true. They have a printing press. All fiat currencies have printing presses. But if you're gonna have a printing press, you can't also tell me that you don't have an inflation problem. And if inflation has already jumped the sharp 2% to 9%, in reality 20%, you can't tell me that the central bank can just say, I'm going to inflate it all away. So you're gonna have to have the public buy this debt. Not the central bank, and the public demands a real interest rate on that debt. So yes, public debt does matter, and it matters in a big way. We're lapping inexorably higher and higher those borrowing costs, and even though those costs were delayed for a couple of years, they are happening now, and that is causing an economic to erode. That is going to cause earnings to erode, and the illiquidity in the treasury market is already eye-popping. You see treasury yields trade like, I say, small cap at pink sheet stocks would trade. Let's see what happens in March of 2024. That's when the crash is going to happen. As TLT keeps on going higher, crude oil dives below $70. Eyes on 50s deflation will creep in. People think it's good for risk assets, but they forget about the lag effect from the high interest rates. It will drain liquidity. Then all of a sudden, the Fed starts cutting rates, and the crash will happen again. Only this time, the crash will be bigger than ever. You are such a good boy for watching my video right till the end. Bye.